Hey everyone, welcome back to another video. In this video, I'm going to be doing an intrinsic value analysis for Western Midstream Partners, and this company has clearly outperformed the market over the last year. Overall, S&P 500 is down about 10%. Western Midstream Partners is up about 50%, but they are a rather new company. We can see they really only went public around 2018 or February, and in 2020, when the global lockdown measures went into place, they hit a all-time low share price of around $3.20 per share, and since then they've increased to almost $30 per share. So that's a 1,000% increase since their all-time lows here. So I'll be interested to see where this stock goes from here. But essentially in this video, I'm just going to look at their third quarter financial results and then also cover a little bit of the recent news that's been surrounding Western Midstream Partners, and then lastly figure out the intrinsic value per share for the company to note if this is a good buying price to buy into the company from a value investing perspective. And so right here I found this article that's comparing Western Midstream to one of their main competitors called Energy Transfer, and they point out in the article here that ET is larger and more well diversified and they have a higher distribution yield, but WES has a lower leverage ratio, meaning they have less debt sitting on their balance sheet, and they have higher free cash flow yield, which is basically the operating cash flow minus the capital expenditures for the company. And so right here, I just wanted to point out something interesting in these two paragraphs. First and foremost, they point out that Western Midstream has been making efforts to execute additional long-term contracts with Occidental Petroleum to strengthen their cash flow stability, as that's one of the bigger segments of their business. And obviously, as the article pointed out, cash flow is one of this company's main strengths and one of the things that makes them an attractive investment. And they sold a non-core stake in something in their company called Cactus, which they sold for $265 million, and they plan to basically just recycle that into share rebuybacks and share repurchases. We can see right here that as a result of the Cactus sale, the board of directors for the company increased their repurchase program to about $1.25 billion. And so that is obviously one of their main priorities moving forward, is capital allocation and redistribution back to shareholders. So that's probably the main thing that makes this company so attractive, and we'll get more of an in-depth look of that into their financial statements here. And so this is their income statement, and we can see they're comparing the 3 months ended September 30th, 2022 to 2021. Over that time period, their revenues have increased from around $763 million to around $837 million. And if I scroll down here, we can see their net income has increased from about $250 million to about $259.5 million. So they have experienced an increase in revenue and earnings growth in the same time period that the rest of the market has really been struggling. So that's definitely a good sign. We can also see right here, this is their balance sheet on page 8, comparing September 30th, 2022 to December 31st, 2021. During that time period, the total assets have increased from $11.2 billion to $11.4 billion worth of total assets. Total liabilities have also increased from $8.1 billion to $8.46 billion, and their total equity and partners capital has decreased very minimally from about $3.09 billion to $3.005 billion. So not that much of a decrease. Mainly their equity has stayed the same over that period. Then on page 11 here, we can see their cash flow statement. This is where we'll get into getting a better in-depth look at their distributions to shareholders. We can see they're comparing the first 9 months of 2022 to 2021. And in that time period, for the first 9 months of 2022, they've had operating cash flow of over $1.2 billion, and around $468 million worth of this came from the third quarter alone. And then lastly, from their financing activities, we can see that, as the article pointed out, two of the main priorities for this company at the moment are reducing the debt sitting on their balance sheet, as well as redistributing value back to their shareholders. And so we can see repayments of debt is one of their larger line items here at about $1.2 billion in 2022, as well as $1.1 billion in 2021. And then unit repurchases, that's share repurchases, I believe, comes out to be around $447 million, up from $104 million in the first 3 quarters of 2021. So definitely this company is using the cash flows from their business and from their extended contracts with Occidental Petroleum to try to redistribute value back to shareholders and reduce the amount of leverage sitting on their balance sheet. And so right here we can see their intrinsic value per share based on this discounted cash flow model. Yahoo Finance is estimating that this company is going to grow at about 15% for the next 5 years. So I slashed that in half to 7% for the next 5 years after that. They had a little under $1.5 billion of free cash flow in 2021, with about $6 to $7 billion worth of debt on their balance sheet and around 385 million shares outstanding. And so that puts their intrinsic value per share at around $59 per share, with a 50% margin of safety of around $29 per share, which means that Western Midstream Partners, although they're up around 47% over the last year, they're still trading at below a 50% margin of safety based on these Yahoo Finance estimates. So they could be presenting an interesting buying opportunity at the current share price. And also on the right-hand side here, I did a competitor analysis comparing them to some of their main competitors. Energy Transfer was the one that they were compared to in that article. And we can see that across the board, West has better gross profit margin, net profit margin, and return on assets in comparison to the other 3 companies that they're competing against. They're pretty much eclipsing the other companies in terms of profit margin. They have a higher net profit margin than literally all of the other companies combined, and they have a higher return on assets, with Energy Transfer coming in a close second at around 5%. So from a competitor analytical perspective, based on the companies I have listed here, looks like Western Midstream Partners, they could present a good buying opportunity from a competitor perspective. And then also from an intrinsic value standpoint, it looks like if they are able to grow at these projected growth rates of around 7 to a little under 16% for the next decade or so, then the intrinsic value per share comes out to be around $59 per share. But obviously, with a lot of these other energy companies trading in the market right now, particularly in the oil industry, it's kind of tough to say whether these companies are going to continue to grow at this same rate for the next decade or so, just because over the last year, as a result of inflation, that's resulted in an increase in oil prices, and we don't know whether or not Congress is going to start to pass litigation to try to tax some of the profits that these oil companies have experienced. And we also don't know about how the effects of the Russia and Ukraine war are going to affect oil prices in the future. So there are a lot of questions surrounding the energy industry, particularly oil companies. So we'll see where Western Midstream Partners goes from here. But I'd love to know what everyone watching this video thinks about this company. Is it a buying opportunity at the current share price? Let me know your thoughts in the comment section down below. Leave a like on this video, subscribe to the channel, and I'll see everyone in the next one.